So I know it's been a while since my last video. It's going to be a busy couple of months for me, so the videos are going to be slow, but you know I had to make one on this, right? So in case you didn't know, Smith and Wesson is a rather large holding of mine, and they just announced earnings yesterday. The stock tanked in after hours, and then it tanked again during trading today. Spoiler alert, I bought in after hours yesterday, and I bought even more today. So we'll go through that, but just real quick, look at this 1 week chart. So you can see they announced earnings. It was sitting right at $18 a share, fell all the way down 22%, as low as right under $14 a share. All right, it did recover a little bit. I mean, since then it went up 12%. That was nice, but the question is it still undervalued, and what caused this? So what we're going to do is we're going to look at the earnings release, just some of the highlights from it. Then we're going to look at my old valuation, some of the assumptions in that valuation video, and compare those to the most recent quarter and see, you know, did something fundamentally change, or is this just a crazy overreaction? Okay, so let's get started. Let me just show you some highlights from the earnings release. Okay, so here's their Form 8K. This is just like the press release they announced whenever they announced earnings. So if I scroll down here, let's see, I'll get the statement from the CEO, or just the highlights right here. Net sales were $177 million, which is a decrease of 31% from the previous year. Now you got to remember, the previous year was the craze, the riots, the pandemic, the protests, so people were buying guns like crazy, and you're going to see that whenever we look at the NICS, which is an FBI statistic. But anyway, what's interesting here is that it was $50 million higher than it was in the third quarter of fiscal 2020. One other thing with Smith & Wesson is their quarters are not like you think of them. Like, they just ended their third quarter in January, so it's really kind of skewed, but don't worry about that. All right, net income was $65 cents per share. So look at this. 65 cents per diluted share. Okay, that's good. You know, we always look at diluted earnings. Just real quick, look at my previous assumption. Okay, so if you see in my old valuation section on the outline, I had assumed an earnings per share of $2.08. So divided by 4, that's 52 cents a quarter. So it's higher than my previous assumption. Okay, pretty neat. And then I just want to show you some of these comments. So I think what scared a lot of people is that he said something about the market cooling off. Let me try to read it here. You can see it right here. Although the firearms market remains elevated, it has cooled significantly from the height of the pandemic surge. All right, so everybody's like, oh man, the CEO says the market's down, you know, it's time to sell. No, that's not the case. They're still making a ton of money, and they also have no debt. Like, you can see this here. No, I think that's in the CFO statements. Okay, let's go down to see what the CFO said. All right, so here is their CFO and executive vice president. So she said something that's just super interesting to me, okay? Their sales compared to 2021, everybody knows that this was a 31% decrease, but it was a $50 million increase in revenue this quarter versus 2 years ago on nearly the same number of units shipped. That's amazing, right? All right, so let's look at my old valuation, and we'll see what my old number was based on those previous assumptions. Okay. So if you see here, my pre-tax number was $30 a share, my earnings per share growth formula, $26 a share, and my DCF came in at $22 a share. That gave us an average price target of $26 a share, not $28. That's a typo. Okay, so $26 a share. All right, so let's look at these fundamentals that were published in this quarter and see if there's anything that would contradict our previous assumptions. All right. First, though, I want to show you the NICS, the adjusted NICS, or this is the background checks from the FBI. So let me show you this website. All right. So this is from FBI.gov, and this is the NICS firearm checks for every month for the last, I don't know, it goes back to 1999. All right. Or like partially into 1998. So that's awesome. All right. From November 1998 to February 2022. All right, and you can see here they give it to you in this just like god-awful chart. Like, you have to zoom by maneuvering this thing. I swear, the government can't do anything right. All right, they can't even give you a chart, an exportable data. So what did I do? I went through, I put this in Excel, all these numbers. I made sure they were all right because I added up all the totals and made sure I got the same total. So anyway, here it is in Excel, much easier to look at. All right, here we go. You know I love graphs, and just look at this graph, okay? Because this is a great leading indicator of gun performance, you know, Smith and Wesson's performance, as well as other gun brands. If you're like a Ruger shareholder, or I guess that's the only one I can think of off the top of my head. But anyway, look at this, okay? So even though it is down from this pandemic surge that they talked about, this 2020, whenever all the riots, protests were happening, and everybody was buying guns, it's still significantly higher and on a definite uptrend from previously, right? So this is crazy because look at their share price, okay? I'm going to pull up their share price again. Keep in mind this upward trend for the last, what is this, from 2000, I graphed it from 2010 onward. So from 2010 to 2022. So we're going to look at 10 years on the share price. Let me pull it up. Okay, so 10 years, let's see. Yeah, look at this. In 2016, they were selling for $22 a share. Back at the NICS, let me hide this again. 2016, this was, look how much lower it was than the gun sales are now. They were hovering between 2 and 2.5. I mean, that they're at 2.5 now, but they're really hovering between 2.5 and 3. So firearm sales have gone up. You're going to see their income's going up, their revenue's going up, their free cash flow's going up, their equity's going up, but the stock price is lower than it was in 2016. So, okay, that's just a little indicator of what's to come. All right, so now let's look at their financials. I'm actually going to do something different here. I'm going to look at their actual 10Q. I'm not going to look at the graphs. I did that in the other video. You can watch that. That'd just be repetitive. So I want to go through it as the 10Q because, well, the real reason is that I don't have access to that data yet. It just hasn't had time to export. All right, so let me pull up their 10Q. All right, so here is their 10Q, and we said, let me see. All right, let me go first to pre-tax income. All right, so they do their balance sheet first. All right. Usually companies will put what they're most proud of first, and they're proud of their balance sheet because they have like no debt and they have a great debt to equity ratio. Their balance sheet's super strong. That's one of the reasons I like this company so much. All right. So look at this. Here's their income statement for the quarter ended January 31st. So the 3 months ended January 31st. And if you look here, all right, where is income before taxes? All right. Income from continuing operations before taxes. All right, so 39.8, let's just call it $40 million for the quarter. All right, how does that compare to our previous assumption? Well, our previous assumption was 146 million for the year. Divided by 4, 36 million, okay? So our previous assumption was 36 million a quarter. They're doing 39.8 or $40 million a quarter, okay? So that's higher, okay? Nothing to be concerned about there. From an earnings per share standpoint, we already said it was 65 cents a share, so 65. So 65 versus 2.08 divided by 4, 52. So higher there too. Okay, so $0.65 a share on the earnings per share, and we said that the pre-tax income was $40 million. So let's look at return on tangible assets. Just for this quarter, we're only going to do this quarter alone. So what I do is I take, it's pre-tax, so I take that pre-tax income, which was $40 million. So remember that number, $40 million. I'm going to go up here to the balance sheet. All right, and I'm going to take their total assets, which is 469,305, and then I'm going to subtract out goodwill, and I'm going to subtract out intangible assets. So if I do that up here on the calculator, 469,305 minus first their intangibles, so 4257, and then minus their goodwill, which was 19,024. All right, and you can see I get tangible assets of $446 million. All right, so how do I get a pre-tax return on tangible assets from that? I do 40 divided by that number times 4, right? Because it's on a quarterly basis. So 40, 1, 2, 3, divided by 446,024. I had to add the 3 zeros on the 40 or else it would have been skewed. Okay, so that's just 9% for that quarter. But that's on a quarterly basis. So really, if you multiply that by 4, they got 36% return on tangible assets just using this quarter alone, right? So amazing return on tangible assets, nothing to be concerned of there. If you're confused on how I did that, I did $40 million times 4 divided by the total tangible assets. Okay, that's all it was. All right, now let's look at their total liabilities. This is crazy, okay? Total liabilities is $143 million. Their pre-tax income in one quarter, in a down quarter that's got everybody scared about the company, was $40 million. So in one quarter, so if I make that a yearly number, 40 times 4, 160, they could pay off all their liabilities in less than a year with their income that everybody's considering a disappointment. So it's crazy. Okay, so tangible book values next. Let me show you how to do that. So I take stockholders' equity, so 326, 309. I subtract out the same thing I subtracted out for tangible assets. So I subtract out intangibles, so minus 4257, and I subtract out goodwill, so 19,024. All right, there's their tangible book value as I calculated. I mean, some people might subtract out other assets. It's preference. That's not going to make a huge difference here. All right, and then I divide that by the number of shares. I got the number of shares here in the intro section in the top right of the video. All right, so divide that by 48 million. So divide it by 48, and I get tangible book value per share of $6.30. All right. Remember, I like to say that you actually do want to look at tangible book value per share on a growing basis, versus previous to make sure it's growing. So I'm going to pull up their graph again. Let me do that real quick. All right. So here's their tangible book value per share. And this does not count the quarter that just got posted because I don't have that data yet. But you can see that this number would come in right about here. So yeah, it went down a little bit, but I mean, it's not, there's nothing to be concerned about. Look at this trajectory. I mean, it's just, you want a company that's growing tangible book value, tangible equity per share, because that means that the company's growing the shareholders' net worth per share. I mean, that's the best type of company, all right? So let me show you inventory. I'm going to use this graph some more. So remember, we were really concerned with inventory last time, inventory growing. We said that the finished products growing was what really had a lot of people spooked, because we were down here during, the sell-off and all the good times where they were selling a bunch of guns and reducing inventory. And then inventory started creeping up, and people said, oh man, this is not good. If inventory is coming up, especially finished products, that means people aren't buying guns. But Smith and Wesson, in their earnings call last quarter, not this most recent one, last quarter, said that was by design. They were trying to get to an even, manageable finished goods inventory level. They weren't comfortable being down here at this $60 million. They wanted to hold a little over $100 million, all right? So let's see what their finished goods inventory is from their 10Q for this most recent quarter. So you see here, I got inventories, $134 million for the quarter, ended January 31st, 2022. They don't break it down here, all right? But what they do is they break it down further on. So if you want to figure that out, you just Control F and you do finished goods. So you can see here up at the top, I did Control F finished goods. And you can see right here, finished goods, they have $50 million, but they also have $64 million of finished parts. So you actually have to add both of these together. So if I add these together, 50 plus 64, I get $114 million of finished inventory, all right? So where does that compare to the previous graph? Let's look. $114 million is just right here. So not a concern. This is by design. It's nothing drastic. This is something that's not scaring me at all either. All right. Lastly, we're going to look at what their free cash flow was. All right. So let me go back to the 10Q. All right. To do that, I got to go to their cash flow statement. All right. Where's their cash flow statement? This isn't it. Okay, here it is. The cash flow statement for the 9 months ended. So they don't count their cash flow by quarter. They're going to do it on a 9-month basis. We got to keep that in mind. So how do we get free cash flow? It's total cash from operating activities minus capital expenditures, all right? So you can see here, $112 million from operating activities is the cash from operating activities. So $112 million, or I'll do $112,275. And then their capital expenditures is going to be in the investing section. So if I look at cash flows from investing, I'm looking for purchase of new equipment or, payments to acquire property, plant, and equipment. So you can see here, yep, right here, payments to acquire property, plant, and equipment. So I'm going to subtract 15,090, so minus 15,090. That's going to give me free cash flow, okay? So I have $97 million of free cash flow, 97,185. On a 9-month basis. So 9 months is 3 quarters, right? So how do I get that? How do I compare that to what our estimate was, $120 million? Well, I just do 97. So let me just clear this. 97 divided by 3 times 4. All right, and I get 129 million. I mean, it's crazy. I mean, it's lower for sure. I mean, it's higher for sure. It's higher than our conservative estimate last time. This is insane. I don't know why the market can be this irrational sometimes, but it's good for me, right? It's good for us. Okay, so 129 million per year. All right, let's do a new valuation. Let's just make sure nothing's crazy's changed. And all right, new valuation is going to be pre-tax income times 4 to get it yearly, times 10 divided by 48, so 33. This is insane. All right, earnings per share method. And you know what I'm going to do this time? I'm going to just put 1% growth because I want to be extra conservative, all right? So their new earnings per share is 65 cents, so 65 cents times 4, all right, times 8.5 plus 2 times 1. So let's just say they're growing at 1% per year, which is much higher than that. Well, I don't know, it was 2 last time, and that was conservative. So, all right, $27 a share. It's, all right, and then my discounted cash flow, I'm going to say 129 million, perpetual growth rate 1%, and a discount rate, I'll keep it at 15. Okay, usually I discount at 13 now, but I'll just keep it at 15 because that's being consistent. All right, so I get a net present value of $1 billion. This says B, but it should be an M. So 1.06 billion. So 1,060 million divided by 48. All right, so 22 again. Okay, whatever. You can see then this one's probably the closest, and that's reasonable, but I think we also took super conservative assumptions with low growth and, well, we're really just in the low growth. But, I mean, even 22 at our lowest possible valuation, 22 divided by the current share price is like a 40% upside. you can see that's why I bought more, okay? Obviously, what I think happened is that people were expecting like some big surge for some reason, or they just saw the minus 30% revenue from the previous year and didn't know what they were doing. It sold or not. I got no idea. But anyway, I am happy I got to scoop up some more at a lower share price. I would have liked to have it just go up, but you know, it is what it is. So I'll sit here and wait and hold on to my shares until it does reach this target price or higher. So that's all I got. If you enjoyed the video, please like and subscribe, comment if you got questions, suggestions, or you disagree with me.